You know, when you're looking at a chart, it can feel like you're just staring at random noise. But what if I told you there's a story being told in those candles? That there are literal footprints left behind by the biggest players in the game? Today, we're going to learn how to read those footprints.
We've all been there, right? You're watching the price, everything seems calm, and then, bam! A huge move just explodes on the screen and you're left sitting there wondering, what just happened? It feels like you missed the memo. Well, those moves aren't random, and you didn't miss the memo. You just need to know what to look for. So here's our game plan for today. We're going to start with what a fair value gap actually is. Then, we'll get into the nitty-gritty of how to spot one on your charts. After that, we'll talk strategy, how to trade these things. We'll also cover the crucial part, what to do when they don't work. And we'll wrap it all up with some pro tips to make you a whole lot more efficient.
Okay, let's dive right in. First things first, what exactly is this clue that the market leaves behind for us?
You see, those massive, sudden moves, they're not just happening. That's the work of big institutions, what traders call smart money. When they enter the market, they do it with so much force that they literally leave a trace, a footprint. And our job, as traders, is to become expert trackers.
And that footprint has a name. It's called a fair value gap, or FVG for short. Just think of it like this. The price moved so aggressively, so fast, that it skipped over some prices entirely. There was no time for normal buying and selling to happen. It's an inefficiency, a literal gap in the market story that, well, the market often feels the need to go back and fill in.
All right, so that's the theory. But how do we actually find these things on a chart? It's way simpler than you might think. It all boils down to a simple 3-candle pattern.
Think of it like a little 3-act play. First, you've got candle 1, just setting the scene. Then comes the star of the show, candle 2. This is always a big, powerful, impulsive candle. It's the one that does all the work. And finally, you have candle 3, which comes after the big move. This simple sequence is everything.
Now here's the magic. The fair value gap is the empty space between the top of that first candle and the bottom of the third candle. You'll notice their wicks don't overlap at all. That empty void, that's the imbalance. That's the footprint. And believe me, that gap often acts like a magnet for price in the future.
Okay, so now we can find them. That's awesome. But spotting them is one thing. How do we actually trade them? This is where the real strategy kicks in.
So here's the fundamental belief behind trading FVGs. Markets are like nature. They hate a vacuum. They crave balance. And these gaps, they're an imbalance. So the market has this powerful tendency to revisit these prices to, fill the gap before it continues on its way. That revisit is our opportunity.
Now, you could just enter a trade anywhere inside that gap, but the pros look for a better price. And a super common way to do that is to simply split the gap in half. This little trick gives you a much better risk-to-reward ratio, and it creates 2 important zones, a premium zone and a discount zone.
And the logic here is just, well, it's common sense, really. If you're looking to buy because you see a bullish FVG, you want a good deal, right? So you wait for price to come down into the discount or lower half of the gap. On the flip side, if you're looking to sell into a bearish FVG, you want to sell at a high price. So you wait for it to rally up into the premium half. It's all about getting the best price.
So let's put it all together into a simple plan. Step 1, wait patiently for the price to pull back into our zone. Step 2, look for some kind of confirmation, a sign that the original momentum is kicking back in. Step 3, place your stop loss just on the other side of the gap to protect yourself. And step 4, aim for a logical target, like the high or low that started the whole move.
Of course, in trading, nothing works 100% of the time. But this is where the pros really separate themselves from the amateurs. A failed setup isn't a failure. It's just new information. It's an opportunity to pivot.
So imagine this. You found the perfect FVG. You're waiting for the perfect entry, and then price just slices right through it like it's not even there. What does that tell you? Well, it's a massive clue. It's telling you that the market's intention has completely changed.
When this happens, it creates something called an inverse fair value gap, or IFVG. The old gap totally flips its role. Think of it like this. What was once a floor that was supposed to hold price up has now broken and become the new ceiling. Support becomes resistance. It's a total role reversal. If a bullish gap fails, that area that should have been support is now very likely to be resistance. And if a bearish gap that should have been resistance fails, it's now probably going to act as support.
This is so powerful because it means a failed trade can immediately turn into a brand new opportunity in the other direction.
Okay, we've covered the what, the how, and the what if. So let's wrap this up with a few quick pro tips to help you use this stuff effectively and efficiently.
First off, context is king. An FVG on a 1-minute chart is for a scalper. One on a 4-hour chart is for a swing trader. Make sure you're using the right time frame for your style. Second, not all gaps are created equal. You want to look for the ones with a huge, explosive middle candle. Those show real intention. And lastly, a bit of an advanced tip. When a trade is working and a new FVG forms in your direction, that can be a high probability spot to add to your winning position.
So, when you boil it all down, what's the most important thing to remember? Fair value gaps aren't just some random candlestick pattern. They are a direct window into the market's intention. They show you exactly where the big money pushed the price so hard that it left a void.
Once you start seeing these gaps, you can't unsee them. And the charts stop looking like random noise and start looking like a map full of clues left behind by the market itself. The only question is, what are you going to do with those clues?